Oliver, not long until the end of the quarter now, and it's looking like it's going to be one of the worst quarters for M&A in a long time, probably since the crisis. And here on Lex, we're generally skeptical on most M&A deals. The academic literature would back that up, saying most of them destroy value. Most of the papers tomorrow probably say that, or towards the end of the quarter, will say that this is a bad thing, that there's not much M&A. Sounds like a good thing, no?
Yeah, if you're an investor, it's a pretty good thing. It's obviously a pretty bad thing if you're an M&A banker. I imagine a lot of them are pretty quiet at the moment, not much going on. But for investors, certainly investors in companies who might potentially be acquirers, it's probably pretty good news. A lot of deals destroy value. You look at the big recent deal announcement, EADS and BAE, and one of the reasons that's often given for that is that BAE has made a lot of acquisitions in US defence and they've not really paid off, and that BAE has now left itself with enormous exposure to a very much declining market. So from that point of view, M&A really doesn't always pay off.
And one of our big bugbears, of course, on Lex is that companies always say, or quite often say, that they're doing a deal to diversify. And we always argue that diversification in of itself adds no value to shareholders. You can just as easily go and buy a company in fast-growing Asia in the market. It's something that investors need to look at very closely, isn't it? Synergies.
Yeah, synergies is the big thing to look for when any deal is announced. The two important numbers are firstly the price and secondly the cost savings. Now, companies will often talk about revenue synergies and cost synergies. Revenue synergies is the extra sales they hope to get by putting the two products together. This is really hard to do well, and really hard to prove that you're doing well. Investors should always be very skeptical of revenue synergies. Cost synergies, or cost savings more accurately, is the far more important thing. This is where you can actually save money and do something that the investor couldn't do alone. Save money by combining purchasing power or by combining head office costs, whatever it is. You look at two recent deals in the beer sector and there's very different approaches. AB InBev, the big brewer, recently bought Grupo Modelo in Mexico. They immediately outlined how much cost savings they expected to get from that deal. Over in Asia, Heineken has bought out the part of Asia Pacific breweries that it doesn't already own, but it's been saying that's all about growth and has given no number at all for the amount of cost savings that it intends to get, if any at all. I know which I will be going for.
Yeah, so beware revenue synergies. Cost synergies are important, and also the track record of management and being able to deliver them, right? That's also
it's also very important. Again, AB InBev has a great track record of this. When they put together Anheuser-Busch and InBev several years ago, they well exceeded the cost saving targets there, which as an investor will give me real confidence that they can do the same thing again when it comes to Modelo. So you want to look for companies that have a really good track record.
And what about size too? What are we seeing in the numbers on size of deals?
We're generally seeing that deals are getting, if anything, a little smaller since the crisis. The days of the mega deal, BAE and EADS notwithstanding, and also Glencore and Strata, but the days of the mega deal are behind us. Companies are going for smaller bolt-on deals, which I think for investors is a good thing.
Well, that's interesting that there aren't many deals. Certainly companies seem to be very happy to buy their own shares. So let's hope for some better numbers from the fourth quarter. I'm sure the bankers are wanting that. Thanks very much, Oliver.